Hello and welcome to the Index Investor, where we decode the world of passive investing in simple, actionable terms. Today's episode dives into a style of investing that calls itself passive with a brain, smart beta. Is it really the best of both worlds or just active investing in disguise? And to help us navigate this space, we are joined by Major Ashish Chadha. He's been running an investment consultancy for over 2 decades now. Welcome, Major Chadha.
Thank you very much, ma'am.
So let's begin with the basics. Can you please start with explaining what exactly is smart beta and how is it different from traditional index investing?
Yes, ma'am. So let me explain to you what is index investing first. So index investing is basically you select companies basis the market cap weightage, and which is finally it boils down to the how well or how badly a company is doing. It's a very competitive space, 50 shares, 100 shares, 500 shares that come onto the index. And if a company is not able to keep its, while momentum will sustain it for some time, but finally the earnings growth and sales growth is what keeps it on on those respective indices. In the case of smart beta, that is not the case. While it is, it is an ETF, all right, but it tries to take the benefits of a passively managed fund. So basically, what happens is that the humans make the rules here,
Mm-hmm.
and the stocks that are selected follow the rules. So
Mm-hmm.
it is neither active nor passive, or it is half man, half woman. So it comes between between an active fund and a passive fund. The it is What happens here is that these stocks will run as per the algorithm or the rules, but the rules are made by by humans basically.
So these funds, they often use terms like quality, value, momentum, and many investors, they find it confusing. So it would be great if you could break down these terms for our viewers.
Surely, ma'am. So, the good thing about our industry is we thrive on semantics and jargon, makes us look more intelligent, right? Something that we have followed here at Chadha Investments over decades is try and keep it as simple as possible. But of course, there are times when, for example, right now in the US, tech is hot. So any fund which is in momentum, which is investing in tech stocks, that will be obviously doing very well. So that is what you call a momentum fund. So P ratios can be outrageous. For example, Tesla, I think, has a P ratio of 300 plus. You have Palantir sitting at 150% at a P of 150. India also had the same phase, back when Infosys and Satyam and Pentafor were doing well in 2000. You had banks in India doing very well. So at that point in time, the momentum was in favor. But there was a time, for example, back in 2000, it's easier to refer, everybody was investing in tech.
Right.
Stocks were, the infrastructure stocks had gone dormant completely. So, they were available at dirt cheap valuations. So anybody who did value investing at that point in time, when the tide turned and tech fell, this did very well. And of course, 2 years ago, you were in a situation where small caps were just running away completely. Everybody, Banta Singh, Santa Singh, and Muthuswamy, everybody was buying small caps. At that point in time, cash flows of companies had been forgotten. And if anybody had picked up companies with good fundamentals, they would have been able to invest in quality stocks at that point in time. So typically, when the market is in a booming phase, it's always better to be either in value on a value style or a quality style. And if the market is dead, then probably a momentum or a growth style. That's slightly contrarian, but I'm just explaining. And there are some companies which grow very fast. We've had various phases. AI, for example, the semiconductor industry overseas. India, I don't think has too much of growth investing in the classical sense where companies grow at 30, 40, 50%. Our rates have been more like 15, 20, 25. That qualifies as a growth style. So all these four styles, they're four basic styles. Then of course you will have variations on all this.
So as you said, these strategies, they're often called rule-based, but they don't track plain vanilla indices like the Nifty 50 or Sensex. So here's the obvious question then. Do smart beta funds bring back the risks of active investing?
Ma'am, absolutely. So, there's a joke on this which will explain it, cutting the jargon out. There was a friend of mine in Ludhiana who was sitting wearing a suit and a tie. So when I walked into his house, I asked him, I said, Raji, ek hi paya hua hai. You're looking very smart with this lovely tie and suit. And he got up to, wish me. And then I realized he was wearing a short with slippers. So I said, I don't get this. He says, I'm wearing the tie and the suit just in case somebody walks in. And just in case nobody comes, then I'm wearing a short and a chappal. So that is, so when you're investing in smart beta, you have to be very careful because what happens, ma'am, is that everybody is following a particular style, right? Now it is possible, like these days, FMCG, for example, if you were to run a quality fund, it would not go anywhere at this point, at this particular point in time. FMCG stocks are out of fashion. So they're quality stocks in the value space. So you can have very long periods of no performance, And on the other hand, last year was, where all AMCs launched a plethora of momentum-based, and they're all doing quite badly. So you have to be very careful here. Firstly, you should have a personal understanding of the markets, and you have to somewhere along the way you have to time it over an index fund. So there is a sector risk, there is a concentration risk, and if too many AMCs start launching similar kind of funds, then all of a sudden, just the sheer money flow will drive prices up, unevenly. And when the sector goes out of favor, then all of a sudden you could see a crash. A lot of businesses have taken a hit, and if your portfolio is weighted towards pharma, you would have taken a hit. Similarly, when COVID happened, if you were running a momentum strategy in the first few months of COVID, it would have been a mess. So all these things together, you have to be. Plus, there is if the market cycle changes unexpectedly, then all of a sudden a particular factor approach could go out of fashion. So you try and overcome that by doing something called as a multi-factor strategy that again comes with its share of advantages and disadvantages. And also what happens, ma'am, in a diversified active portfolio or an index, you have different types of companies. There you will end up, but again, to use jargon, it's called an idiosyncratic risk, which is unsystematic basically, because you are in similar kind of shares. And of course, if the factor itself is designed badly, then that could be a problem. So all these things have to be given weightage.
So are you saying that there's a danger of high churn and too much complexity under the hood?
Correct, ma'am. Plus a little bit, they tend to be a little more expensive, So when you are buying this, you have to be really smart. Just because it shows up on the reporting, financial services companies that report performance. Just because it shows up high on the charts doesn't mean that you go and stick money. Otherwise, you could lose a lot of money. And Indian investors who went to momentum are experiencing it the hard way right now.
Right. So, like you said, performance is where the rubber meets the road. So, have smart beta funds in India actually delivered better returns, and how do they stack up historically versus the traditional index funds and even actively managed funds for that matter?
So, ma'am, I've been personally investing my own money from, I think, 2016 or so when they started in India. And we've been investing overseas now also, probably slightly before that. When you are investing in a smart beta, then you have to be very clear that you cannot stay for the long term. If you have a view and you don't want to get into a stock specific, if you don't want to take the risk of a stock specific investment, then this is probably a safer way of playing a theme. It's more diversified than a single stock. I'm giving you both the advantages and the disadvantages before I give my 2 pennies output on it. But if you do not understand themes, and you don't have the time to spend in terms of tracking your investment, then I think smart beta is not for you. Because single theme factors can get into, you could end up completely out of sync with what happens when you started. That's very important to be kept in mind. A multi-factor product which has different factors is probably safer, but it will not be half as much fun as a pure momentum when it is in momentum, or a quality or a growth or a value when when that asset class is doing well. In India, again, I have personal experience of this. I think index funds have done much better over a longer period of time. To be fair, smart beta funds in India are relatively new. The 2, 3 funds that we've held for a longer period of time, by and large, as time goes longer, my belief is, because I've seen it practically, index funds will probably do better. In the shorter term, smart beta is better, but you'll end up paying obviously more taxes and maybe a higher level of churn.
Okay, and how about comparing them with actively managed funds?
Ma'am, a multi-factor, again, this is a shorter version of an active. So it is a smarter version of an actively managed fund, which is playing momentum. It is a smarter version because, all the stocks are similar, but you have to bail out from this faster than an actively managed fund, because actively managed funds have more, they have more regulatory compliances. So let me put it this way. If you are like Dharmender, or Virender Sehwag, then in cricketing terms, then a factor fund is probably better for you. But if you are, you want to be like Rahul Dravid, or in cricketing terms again, or you want to be aggressive in a prudent way, then I think an actively managed fund is better.
Now, boiling down this conversation to one final question. Who are these funds meant for? You did say that somebody who is investing with a shorter time frame in mind, probably who is ready to jump from one factor to another. But should beginners even consider smart beta funds, or are they more suited for advanced investors who can monitor and understand the underlying factors?
So, ma'am, let me give you something interesting, because it's something we do at work. Young men like these products. High testosterone. So young men or people, this is like typically a more exciting product. And it is quite possible that, if you notice, Robert Clive, became the Nawab of India at a young age of 20 when he captured, places in Arcot. Then, of course, he came a little later to Calcutta. So most, young men are the ones who climb mountains. I have a military background. So, if you've got to make somebody climb up, an 18 to 25-year-old is more likely to say, yes, I'm going to volunteer. So the Indian Army never has a problem of, guys wanting to assault even a difficult post. So I think this appeals more to the younger male population. Whether they understand it or not is not the point, But prudence, as I grow older, prudence would suggest, you should stay away from this if you're a beginner. If you're a seasoned, smart guy who has his finger on the pulse, or their investment advisor is on the ball, and you're willing to risk the higher taxes, and the you think you are smart enough to catch a trend, and see, getting in is like Abhimanyu. On these products, you have to learn to get out. So if you do that well, then I think there is an opportunity here for sure.
Well, thank you, Major Chadha, for taking time out and helping our viewers make sense of smart beta funds. Thank you for joining in.
Thank you, ma'am. Thank you for inviting me over.
Thank you for watching. We'll catch you in the next episode of Index Investor very soon.